Big bounce in markets this morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, after a wild 24 hours in markets, stocks look to snap a 3-day losing streak as countries rush to the tariff negotiating table.
More alarm bells, though, ringing on Wall Street. Goldman Sachs warns of a bear market, while billionaire Ken Griffin calls Trump's tariffs a huge policy mistake.
And you also have analysts echoing that gloomy take, with stocks facing another big test this week. Earnings season begins on Friday. Let's get a check on these markets right now. We had quite the fireworks yesterday. Ended up pretty neutral when it comes to the close. But then you take a look at where we are on futures right now, higher by 2.4%. A lot of that comes down to what the Treasury Secretary just said a little while ago, that tariffs are a melting ice cube and ice cubes get smaller. Look at the bond market, though. 10-year Treasury yields rose by nearly 19 basis points yesterday. That selling pressure continues to a lesser degree right now. Matt Miller up about 3 basis points.
All right, NVIDIA is leading the Mag 7 higher. The Bloomberg Magnificent 7 index is down 24% year to date, but this big heavyweight is up almost 5% in the pre-market. And if it holds, that's very good news for the indexes on which it's so heavily weighted.
And I'm looking at your auto sector for you, Matt Miller. I'm looking at Stellantis in particular because a union reported first quarter production in Italy down 35%. The firm is also looking into ways to help offset supplier tariff costs. Stellantis is down 2.7%. And the tariff messaging from the White House is keeping investors on edge. This morning, Treasury Secretary Scott Bessent told CNBC that he hopes tariffs will be, as Katie is saying, a melting ice cube. We're going to bring in Bloomberg's Tyler Kendall, who spoke with Bessent last night. She joins us from the White House. How quickly does the ice cube melt? Because, of course, we're hitting that April 9th deadline, rushing to race to meet those other countries to bring back the reciprocity here. How do you see this playing out even in the next 24 hours?
Yeah, hey, Sonali. Well, Treasury Secretary Scott Bessent told me that any deals ahead of tomorrow are not likely at this point, and that also everything is on the table, including potentially lowering the 10% tariff that's currently in place across the board, if that is what ends up coming from these negotiations as they move forward. He also told me that all countries he's optimistic about striking a deal with. Now, the difference between optimistic and realistic remains to be seen, as there is still so much uncertainty from this White House about exactly what they need to strike a deal, and also, of course, the timeline there. And we are also getting some conflicting messages from this White House. Just yesterday, a senior advisor to President Trump, Peter Navarro, penning an op-ed saying that this is not a negotiation, really doubling down some of his recent comments that any carve-outs or exemptions ultimately could undermine the business case when it comes to investment and reshoring in the U.S. Now, we should, of course, note that it is appearing increasingly likely it's going to take more than just lowering or eliminating tariff barriers, as well as eliminating trade surpluses with the U.S., because that is exactly what Israeli Prime Minister Benjamin Netanyahu had floated to President Trump yesterday in the Oval Office. And when asked if that would be enough, President Trump said maybe not.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there reporting live from the White House. Now, Goldman Sachs is preparing for a cyclical bear market despite the negotiations and tariffs. In a note out today, strategists say the event-driven bear market from tariffs could, quote, easily morph into a cyclical bear market given growing recession risks. Goldman Sachs chief global equity strategist Peter Oppenheimer joined Bloomberg this morning.
Our economists believe that the probability of a recession in the US, for example, over the next 12 months is now around 45%. But indeed, if the full expected tariffs come through and there is no pullback, that would likely trigger a recession. And look, in a recession, typically profits do fall anywhere from sort of 10 to 20% or more, depending on what industries they're in and in what region.
And that, of course, is just one of several warnings coming from Wall Street in the past 48 hours. Let's discuss at the desk with Bloomberg's Bailey Lipschultz. And Bailey, I want to focus specifically on the Goldman call. So the idea there is that what we're seeing right now, it could turn into a longer-lasting cyclical bear market. That seems different and much worse than the event-driven bear market that they think we're in right now.
No, exactly, Katie. And that's kind of that prolonged downside. And when we talk to investors, the big uncertainty for them is what happens next. Obviously, as you can see, futures are up 2.5% right now, but that still doesn't signal, is this a near-term bounce? Is this the start of something that is longer lasting and ends up bringing major averages further down, double digits further down? Because when I talk to investors, if the tariffs are rolled back, we're going to rip. But if we continue to see the Trump administration not back down and lean into these tariffs, then that could kickstart another 10 to 20% downside. And that's really kind of the fundamental thesis. Again, if Goldman economists are right now raising the probability of a U.S. recession to 45%, so that's becoming very quickly discussed. And even Larry Fink, I think yesterday, said most CEOs he talks to think we're already there.
He said the economy is weakening as we speak. He said that yesterday. That felt pretty dramatic.
That we're already in a recession. Yeah, that was.
Yeah, most CEOs. And then you also see that, frankly, during the small business optimism, you see that optimism fading for a lot of players. I also want to point out this note from Barclays this morning because interesting, they say that a lot of the deleveraging you've seen in the hedge fund industry, particularly with systematic funds, might have been washed out. But retail funds, where you excel here, I'm shocked at how closely you can keep an eye on those retail traders. It seems like there's a long way to go still.
Yeah, they're not capitulating and they're not really worried because when you talk to retail traders, for the most part, the thought is every time prices move lower, it's an opportunity for it to be cheaper for the long run. But when we talk to some folks who manage IRAs, they are seeing some panic from older people who are closer to retirement. If you're in your 60s, maybe you do actually want to get and scale back your exposure to equities, because the big thing is you've been rewarded with back-to-back years of huge returns for the S&P 500, but at some point you have to pay for that volatility.
Matt, they have a word for that. It's cut your losses.
Cut your losses, something you got to learn to do. Bailey, thanks so much for joining us. Bailey Lipschultz from Bloomberg News. Now, even the biggest bulls on Wall Street are tempering expectations. Over the weekend, Oppenheimer's John Stoltzfus lowered his year-end S&P 500 price target by 1,100 points from 7,100 to just under 6,000. John joins us now. Great to have you on the program, John. I wonder, first off, if you think that we hit a bottom yesterday and now that this bounce is sustainable.
Matt, thanks for having me on the show. Always great to be on Bloomberg TV with you. Really, I don't think yesterday is, I think what it was, we had two things happen yesterday. There was the false news, that came out that there was going to be a pivot from the administration, and the market soared. And then later on during the day, with the news about negotiations with Japan, that kind of eased things. I think that, this is the beginning of the recovery process from this. Everybody was in shock by the degree of the tariffs. I think everybody had expected tariffs, but it was like a big difference from tariffs 101 in the administration's previous run in the White House, and now essentially tariffs 401, senior year, It's got to think here. The market's looking for cooler heads to prevail on this. I think there's opportunity, and those cooler heads have got to be from both sides, because the reciprocal action, for instance, from China doesn't help anything, because then you'll go back and forth like pickleball volley, wild stuff happening, and a lot of attention to it, but that's a lot of egos. The reality is this does present serious problems for businesses and communities and the as well as the consumer. But at the same time, you have to say one thing about this administration. It is actually addressing problems that have been kicked down the road for over 40, 30, 20, and 10 years, as the world really moved to those who export to this country and those of us buying the stuff that they sell, and our loss of significant amounts of manufacturing that's key, whether it's in healthcare or whether it's in technology, that are really related to national security.
So, John, I think a lot of investors and analysts would agree with you that the intention is there, maybe quibbling with the execution of sort of reversing some of those dynamics. But I actually want to go back to what happened yesterday. As you phrased it, fake news. We got those headlines while we were on air on this show. I'll just say that X account, Walter Bloomberg, not actually affiliated with Bloomberg. But I feel like there might be a teachable moment there because the reaction was so violent to the upside. I feel like it really exposed the risk of being too underweight if and when we do get some relief in the form of headlines on tariffs.
Oh, Katie, it most certainly showed where the markets want to go. And the markets are looking at, the view is, its goal is beyond this. And related to when people ask us, well, what would you be putting on your shopping lists right now? We've got to say it looks like technology, communication services, industrials, consumer discretionary, and financials, what we've liked for a long time here, because these have been among the most brutalized sectors in this thing. The overselling looks to us like at different points the negative pitch book that we'd seen in 2022, which predicted all kinds of things that never happened. The only thing that did happen is the market was driven into a bear market. That was looking like a winning volley there for a bit here. But I think yesterday what happened really points to the fact that if all of this is going to go to the ultimate negative, projected into infinity negative outcome, it's too awful to consider. You've got to figure, cooler heads will prevail. I mean, I'm so old. I was a kid, a little kid, but a kid who was interested in global politics when the Cuban Missile Crisis occurred. It looked really serious when Khrushchev was in Cuba, and Kennedy and both Jack and Robert
John,
were fighting them, but that worked out.
John, while we all wait for cooler heads to prevail, I want to point out where the VIX is right now, because even though you're watching futures rip this morning, really take a breather, you are still watching the VIX above a 40 handle or near a 40 handle. It is lower than we've seen the last couple of days, but this is still an extremely volatile market. How do you play that? Doesn't that mean that you can stand seeing your face ripped off in this market if you get in too soon?
Well, that's, it's funny. It's a real good question, Sonali. When we get asked that a lot, people say, do I back the truck up into this? Do I consider this being perhaps one of the best buying periods that we've seen in a while since COVID or since the great financial crisis? And we say, we wouldn't do that right now. We wouldn't be selling into this. We think very early it was too late to start getting defensive, but it certainly was a good opportunity not to look to buy the dips as much as buy the babies that get tossed out with the bathwater, that are those stocks that are likely to carry us higher going forward. But we think we're getting to a point where people, can feel more comfortable. Managers with more conservative mandates will actually be able to consider dollar cost averaging in this place and recognize the fact that we're not going back to the slide rule or the abacus or abacus, however one wants to pronounce it. Essentially, we're dealing with globalization becoming revitalized, diversified away from one country centricity.
Right.
The U.S. getting some of its manufacturing back, and in the process of that, probably a healthier economy than we've had in decades.
All right, John, you're sticking with us. We'll come back to you in a moment. That is John Stoltzfus. I do want to mention some breaking news in the form of a Truth Social post from the president. He says that he had a great call with the acting president of South Korea on the topic of China. Trump says that China wants to make a deal badly and that we are waiting for China's call. We'll bring you the details as we get them. But coming up, Apple set to snap a historic sell-off. We'll take a closer look at the stock next. This is Open Interest.
It would take years to even make that more than 5%, just given the logistics and the nature of India, in terms of as Apple tries to move some stuff there. Look, no company in the world is hurt more from once that came out of Trump's mouth in terms of Taiwan and China tariffs than Apple.
And that was Wedbush analyst Dan Ives speaking to Bloomberg yesterday about Apple. And shares are up pre-market again after the iPhone maker plunged 19% over the past 3 trading days. Apple seeing a wave of panic buying for iPhones as higher prices loom due to Trump's tariffs. Let's discuss with Bloomberg Technology co-host Caroline Hyde. So you are seeing a little bit of relief in the shares right now, but if this is just a pull forward of demand, I mean, how sustainable is that?
And will we not actually see it until its fiscal third quarter earnings? We've got May the 1st as the first set of earnings. We're going to get any sort of testament to what demand has been like of late. And KeyBank, another analyst, has just come out with a price target downgrade because they think there has been soft consumer demand even prior to the tariffs. And then you've got the likes of Dan Ives who are putting out comments like, if you bring it back to the United States and manufacture an iPhone here, it'll cost you $3,500. No one expects them to do that. But even by bringing more iPhones from India, for example, JP Morgan's saying, look, you're going to have to increase the price of your $999 Pro phone by at least $120. You're going to have to see the Pro Max go up by about $350. No wonder every store around America and the world right now feels like it's vacation time, like it's going into the holidays. Every person you speak to in an iPhone store serving customers says they're coming in, they're worried about prices, and they're looking to upgrade right here, right now.
Caroline, we thank you so much for joining us. Of course, this Apple story is one that we're going to be watching very, very closely. It's one of the giants in the room when we think about those trade talks. And we are back now with Oppenheimer Chief Investment Strategist John Stoltzfus. And I want to point out what's been going on this morning, because you are seeing futures edge higher after that brutal 3-day streak in the market. But part of this is because of what is coming out of the White House. For example, Trump speaking about the potential for a trade deal with South Korea, optimism around the situation with Japan. There has been so much negativity around these trade talks. Is there a scenario, John, that you see in which the U.S. does win out?
Well, you know, Sonali, I'd have to say that when you look at the picture here, there is an awful lot of overcapacity in manufacturing around the world that needs to replace the U.S. buying power as the largest consumer nation in the world. If they want to just turn their backs on the U.S. and we wind up, essentially in some kind of a standoff here. The reality is, I think, just as President Trump's constituencies are expressing their concern, making interviews to the press. We've already seen many of his supporters who wrote big checks last year saying that they're displeased with this. You can figure the same thing is happening to leaders around the world when it comes to addressing this, because it has to do with employment, economic growth on both sides of the fences. One of the things that we thought was ironic for quite a few months here was that the foreign markets, particularly the European markets, were outperforming the U.S. beyond valuation underperformance for almost a decade. And I've been a global investor for, almost the whole 42 years I've been in this business. So I like being diversified across the globe, but I'm underweight international. We couldn't help but think, people think that it's only the U.S. could suffer from a trade war. My gosh, everybody else, if you look just China needs the U.S. to a large extent. Their domestic economy is not large enough to absorb our buying power disappearing. And the same thing goes for Europe and elsewhere around the world. I thought it was curious that the greatest leniency that the administration showed in the tariffs really was overall with Latin America, which was interesting. In other words, bring the business back to home. We know that Mexico, of course, has regained its status as the largest exporter into the U.S., taking a lot of business away from China over the course of the Biden administration, the prior Trump administration, and let's see what happens now.
John, great to get some time with you. Thanks so much for joining us. John Stoltzfus there from Oppenheimer, who's cut his target from 7,100 to about 6,000, but reserved the right to raise it again if things take off to the upside. Less than 10 minutes to go until the opening bell. We'll start the trading day with Matt Miskin, Manulife, John Hancock. This is Open Interest.
futures are surging right now after Treasury Secretary Scott Bessent told CNBC this morning, if we're successful, tariffs would be a melting ice cube. Let's discuss with Matt Miskin. He is co-chief investment strategist over at Manulife John Hancock. Matt, great to see you in person. So the thing about ice cubes is they get smaller as they melt. So you could make the case that maybe this is a negotiation tactic. That seems to be what traders are doing right now. Do you think that this bounce, though, is sustainable?
Well, the rates rule everything around me line that last time we talked about, cream, actually still holds. And what I struggle with the bounce is that the 10-year yield is popping higher. Yeah. And so not only is the 401ks across the country failing lower balances, but now mortgage rates are going up. And that isn't healthy. We need actually a softer Fed tone and one where the 10-year yield...
Softer? You want an even softer Fed tone than we got from Jay Powell on Friday?
Pillow soft.
I think actually he was...
That guy was milquetoast.
He was hawkish, I thought. I mean, he didn't even express any concern about the volatility. All right, so there's a dog and a tail. The dog here is the nearly $150 trillion of consumer net worth across the country between real estate and markets. That is what actually drives economic activity. The economy, GDP, is like 27 trillion. That's the tail. So if stocks continue to do what they're doing, and they're their own worst enemy right now, because the volatility is going to make people more concerned about investing. You think about institutionals, risk-adjusted returns, but the wealth effect coming down in that consumer net worth is going to lead to weaker economic activity. And if Powell continues to be hawkish and just holding, I get it, four cuts are in the market right now. That's a lot. But
at the same time as Bill Dudley says, we should expect 5% inflation.
Right.
Put a pin in that. We're going to hold you over to the next block. And also, if we mention yields again, Sonali's going to bring up the basis point trade. So don't.
The basis trade. I wasn't going to do it. So thank you for that.
So don't encourage her. Matt Miskin is going to stay with us. Ahead of the opening bell, let's get a quick check on futures. We're in the green to the tune of 3 1/3%. This is Bloomberg. We've got a rally on our hands, moments away from the start of the cash trade after Scott Bessent said on CNBC that tariffs are a melting ice cube. So that would imply we're going to get down to nothing. S&P futures right now up 3.4%. NASDAQ futures right along with them. You hear the opening bell on the New York Stock Exchange. You've got I believe it's the New York Fire Department, but some sort of firemen, and God, we're really thankful for all that they do. Down on the NASDAQ, you've got Wise working in support of education, which also sounds like something that we should really be thankful for. But no companies ringing the opening bells in this kind of market turmoil. Katie, what are the stocks that you're watching move at the open?
Yeah, let's get to some company shares right now. We have to start with NVIDIA leading the Magnificent Seven higher this morning after yesterday displays one of the most violent swings for U.S. stocks in years. NVIDIA shares finished about 3.5% higher yesterday, Sonali, amid the fray, and currently higher by about 6.5%.
I've got a little more green for you, Katie. Not by much, but Walgreens is up by a little over 1%. People are watching their quarterly profit topping estimates in one of its last earnings as a public company. The firm will not hold an earnings call.
Apple is snapping its biggest three-day drop since 2001. The company reportedly weighing a supply chain shift from China to Italy, India, not Italy. That would be, wow, that would be a real change. But they already make 4/5 of their phones in China. And how fast can that happen? Probably not very. Nonetheless, the shares are up 2 1/3%. Just the intent is enough to drive them higher. We're back with Matt Miskin, co-chief investment strategist at Manulife John Hancock. Do you think the companies are going to be able to move their supply chains that quickly? I mean, also, does it matter if it's in China or in Vietnam or in India? Like, Trump wants it here, right?
This would take years to be able to really move those manufacturing plants back to the United States. And then also, there's just not the workers, the labor force to even do it in the United States. This isn't an actual movement that's likely to be able to happen. We think the tariffs are going to be a constant moving negotiation, if you will. But, you know, I don't know if it's a sinking ice cube or not, but what we're seeing more broadly is quality stocks are the worst performers this year. The better your balance sheet, the better your profit margin, the worse off you are in terms of markets. To us, that is a buying opportunity on a relative basis. And the United States is on sale. We have seen such a massive sentiment shift. You rewind 3 months ago, the United States was the only place in the world to invest. It was an exceptional market. Now, the sentiment around the United States is the underdog. And everywhere else is supposedly the better place to be. We like the U.S. on sale here on a relative basis within equities.
So let's look at that sale. Let's pull up what the S&P 500 sectors have been doing so far this year, because you're right, it's pretty bloody. And want to know where you're shopping. Let's get started. You're seeing consumer discretionary down 18%. A lot of that is Tesla. Information technology down, but even energy, retail, financials, real estate. What do you like?
So technology for us is a buy because the quality elements of it. So they've got the best profit margins, best balance sheets, hundreds of billions of dollars of cash just sitting there. They could do buybacks while they wait. They could pay dividends. They could do a lot of things. Then we're insulating that technology sector with low vol. So that's healthcare, that's utilities, that's things people need versus what they want. So it is more of a barbell strategy, if you will, quality and low vol. We're trying to minimize volatility for investors here, and we're also bringing bonds into the portfolio, which have absorbed some of that volatility pretty well for us.
Yeah, you know, yesterday may be excluded, but I hear what you're saying, and I want to talk about the upcoming earnings season. It starts on Friday with the big banks, and I hear what you're saying when it comes to the U.S. is on sale right now. There's a lot of bargains to be found out there, but is that enough to overwhelm what could be a disappointing earnings season? Because you take a look at the stats from Bloomberg Intelligence, for all of 2025, they now see profits rising 9.4%, which isn't bad, but that figure was 12.5% at the beginning of the year. So earnings expectations are coming down.
And they likely need to come down more. That's a great point. So
and people are lowering multiples, right?
So and this is unfortunately the game that happens with economic slowdowns. You get the multiple contraction, which is sentiment driven, and then you get the earnings revisions. Analysts have not yet woken up to this new potential regime, and they have not revised down the earnings. So it is likely that comes down from high single digits. We think it's going to be low single digits. It might even be flat this year. So that is still coming, but it's all relative. So what earnings are going to hold up the best this year? That's the work you got to do within the equity market. And to us, tech, even though it has sold off, we think is going to hold up better because, again, the margins, the moats, all that good stuff. And then those defensive sectors of what people need versus what they want. And then, you know who doesn't care about earnings? The bond market. Well, the corporate bond market does. But the high quality stuff, they don't mind if it's weaker growth. And we actually are calling for disinflation this year. We think the biggest miss with basically analyzing these tariffs and everything else going on is the thought that inflation is going to accelerate. We actually think it's going to decelerate over the course of the year. That's going to be beneficial to bonds. Maybe the Fed cuts a little more than expected.
I was just going to say, to underline your expectations, or maybe better put, your hope for the Fed this year, how many cuts do you see, and where does the 10-year end 2025?
So our fair value estimate on the 10-year is about 390. So it's still 30 basis points lower, but that's without a recession. If we're in a recession by the end of the year, we think actually the 10-year could have a 2 handle on it.
Ooh.
And that the Fed's going to be cutting more than the 4 times that's priced in. We think the 4 times is basically just, hey, inflation is slowing. We're going to kind of do this more methodically. But the bond market has not priced in a recession by any means, even though the equity market kind of is. So there's still a lot of bond returns left. The Fed hasn't given you the green light yet on the bond market. They're saying red light, hey, we're not done here yet. We're still concerned with inflation, but that could leave them behind the curve if the wealth effect does diminish here, if the economy does slow more than expected. And that's good. Bonds and stocks are not acting the same. The correlations are dropping, which is great for multi-asset investors like ourselves.
Let's finish on that point, because if we do end up in a scenario where 10-year yields are trading with a 2 handle, what is the equity market doing? Because that sounds like a recession to me.
Yeah, it's still likely lower from here. So if you basically look at drawdowns, if it's a non-recession drawdown, expect kind of mid 20% type drawdown. We're already at, 17? We're most of the way there for non-recession. In recession, it's more like 37%. So we've got more. So for us right now, you're getting a lot of price discounts in a non-recession environment, but it isn't pricing in a recession. We are still leaning into bonds relative to stocks, getting some nice income while we wait, mitigating the volatility, and looking for some equity opportunities here as they sell off.
All right, Matt, it's always great to speak with you. Nice to get a good chunk of time with you this morning. That is Manulife, John Hancock's Matt Miskin. Meanwhile, let's look under the hood because we have plenty of movers on our radar. I want to start with Levi Strauss, up 5%. Shares were up as much as 16% at the open. That would have been its most intraday in a year. That's after they reported earnings and seemingly shrugged off the impact from tariffs. Specifically, they said that tariffs will have a minimal impact on their margins in the current quarter. The CEO also said that the company would raise prices surgically, but you can see, Sonali, some of those gains coming back right now.
I've got another tariff story for you. I'm watching Micron because it's rising after a report that it is imposing a surcharge on some products sold in the U.S. to compensate for Trump's tariffs. You're seeing the stock up almost 5%, not the biggest gainer in the Philadelphia Semiconductor Index, but close to it. And you are seeing others, like Bloomberg Intelligence, react that this could dent demand, but clearly this tariff reaction, the early tariff reaction, is not hurting the rebound, at least on the onset. Now we're going to get a look at some other stocks on the move this morning. We are going to bring in Bloomberg's Denitsa Sekova for that.
Yeah, we've been talking about deep buying. We've been talking about deals. Goldman Sachs just upgraded Eli Lilly. They saw a compelling entry point. The stock is up about 4% at the open. Of course, it had a very rough day on Monday. The stock fell after the Trump administration spiked a plan to pay for obesity drugs for Medicare patients. We're seeing a lot of optimism for the stock more broadly. We have 29 buy ratings according to Bloomberg. The stock dropped 13% over the big sell-off in the last 3 days, but clearly the buyers are stepping in. There is some good news and upgrades from Goldman Sachs. One interesting stat is they see the value tripling from 28 to 95 billion by 2030. So a lot of optimism for Eli Lilly from Goldman for sure.
All right, thanks very much for joining us, Denitsa Sekova there. Coming up, Stellantis offers to help its suppliers shoulder tariff costs. We'll look at autos next because there's a lot more than that going on. This is Open Interest.
Welcome back to Open Interest. A quick check on stocks. You have green across the board. Not quite session highs, but pretty close. NVIDIA shares up nearly 6% right now. That's why you see the NASDAQ 100 out in charge. We'll keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Morgan Stanley is upgrading Charles Schwab in its hunt for more defensive exposures. The firm is also upgrading CME and cutting Robinhood. Next up, education technology company Chegg getting downgraded to a sell over at JP Morgan. The firm says that economic weakness will drive students to prioritize making money at secondary jobs ahead of education, which is pretty grim. And finally, GM getting downgraded to a sell over at Bernstein because of the tariff impact. The analyst says that the outlook for GM is, quote, clearly unfavorable. Matt Miller.
Well, let's stay on cars. The maker of Jeeps, Stellantis, is offering to help suppliers shoulder the cost of tariffs. The automaker has outlined a program which its suppliers can apply for as the initial shock of levies on autos and the coming duties on parts rock the industry. For more, we're joined by Bloomberg's Detroit bureau chief, David Welch. And David, so much going on with Stellantis. Their production in Italy has absolutely tanked to levels we haven't seen since the 1950s. And it looks like they're shopping Maserati and Alfa Romeo. At least they've tapped a consultant to look at those units. So what do we know?
Well, look, the company's had a lot of problems. Its cash cow is really the U.S. business, and that business has stumbled. The European business, for any company, but especially Stellantis, is pretty tough. The margins have always been pretty poor, and they've got some of they're strongest in some of the weaker markets with their mainstream brands. So it's not a surprise that they want to shop these luxury brands in the same way that Ferrari was IPO'd a long time with. They're not going to get that kind of money like they did with Ferrari, but if they shop some of these brands, they'll get some cash flow, and it'll also help the company focus. I mean, if you look at Stellantis, it has a bigger family of brands right now than pre-bankruptcy General Motors did when GM was trying to manage stuff like Saab and the old Hummer brand and Pontiac and all this other stuff. It's just a huge burden to do design, product development, marketing for this big house that they've got. So if they can get a little bit of cash and narrow their focus, probably a good thing for them if they can make it happen.
David, did they keep Chrysler and Dodge? Because, yes, those are two brands that they own, but they don't really make any products anymore.
Yeah, you do have minivans, which is still a decent business for them. Maybe the sports sedans, but do you need two whole brands to do that? That's really tough to see. I mean, what they could do with some of these vehicles that they need is just kind of like they did with Ram. It used to be the Dodge Ram, now it's just a Ram. They could still sell it at the same dealerships that sell Jeeps and everything else. And by the way, most of their brands in the U.S. are all under one dealer roof if you go to shop them. So they could have a minivan, and if they wanted to keep one of those rear drive sedans for fleet business and for sports cars, they could just brand it without an overarching brand and then have them sold at the same dealerships who are buying the rest of their line.
David, I've looked at some of the things that have happened since, for example, Porsche spun off. Didn't go that well. I mean, Matt makes a point that it worked for Volkswagen. So you have mixed success in spinning off brands. But in my mind, I guess I'm skeptical because the reason they all came together in the first place was to share the benefits of scale. So are those benefits deeply lost if you see some sort of separating, siphoning, and pushing things away from each other in terms of supply chain?
One of the issues, though, with these sports car brands and some luxury brands is that they don't share enough with the mainstream companies' brands. General Motors makes it work with Cadillac because it's, they have two sedans, but it's largely SUVs, and so they're sharing a lot of SUV parts. When you're talking about sports cars, in luxury sedans, it's a different animal than most of the volume that mainstream brands are getting, which is all in small, medium-sized crossover SUVs. So, are they sharing enough to make that work? I don't know if they're getting enough out of the parts bin for them, and maybe a company like Volkswagen actually would be better because they've got a bunch of luxury brands that have a lot of hardware that could be usable by these brands. I'm not saying Volkswagen's interested in this. I'm just saying they're the kind of company that has made sense because they've already got luxury in their line.
All right, David, great to speak with you as always. That is Bloomberg's David Welch. And we also want to take a look at coal stocks right now, moving higher after our press secretary, Carin Levitt, tweeted or posted that today at 3 p.m., President Trump will sign an executive order to reinvigorate, quote, affordable, reliable, and clean coal. Peabody leading the charge right here, up about 10%, was higher by as much as 18% in the minutes after those headlines dropped. Core Natural Resources and Warrior Met Coal also moving higher on the day. Now, coming up, investors are bracing for sour corporate earnings as the impact of tariffs looms over Wall Street. We'll take a look next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. We're looking at a big rebound. You're going to hear the phrase turnaround Tuesday a lot, like you do every time there's green on the screen Tuesday and Monday was red. But here it's really serious. 3% on the S&P 500, and we were only down, 0.3% yesterday? The NASDAQ 100 up 3% as well as tech stocks really lead the way. Even small caps are getting some love today, so some people really willing to place some bets. In terms of the individual stocks, Nvidia is huge, a gain of almost 7%, and a $2 trillion stock. That means a lot. Tesla up 3.7%. This is a fascinating story that we're going to dig into because Elon Musk has said he thinks tariffs should be zero, at least between the U.S. and Europe, and that seems to go against really the morals of his best friend in the White House. Apple up almost 3% after a 19% decline in 2 days. We gave you the coal story just a moment ago, and then Walgreens Boots Alliance up only 1%, but after earnings kicking off that season.
Speaking of earnings, Wall Street is bracing as more corporate earnings roll out starting later this week. Now, investors are worried about the impact of tariffs on operating margins and earnings outlooks. Here with more, Bill Donahadrick of Bloomberg News. And you're looking at, for example, BI analysis saying that the EPS growth in this first quarter is looking pretty low. It's looking at rising at the slowest pace since the third quarter of 2023. How are investors reacting to these new expectations?
I think the key here is the word uncertainty, obviously, because a lot of companies that are trying to look ahead over the next year, how do they make decisions in this environment? And hence you have analysts cutting down first quarter estimates for what they're expecting for S&P 500 earnings. But we also have a model from Bloomberg Intelligence saying that even with the ratcheting down that we've seen thus far, the estimates suggest that maybe they're a little bit too optimistic at this point and that we could see further downgrades as companies start coming out with.
And we just heard
earnings.
that from Matt Miskin, actually, that analysts are still too optimistic when it comes to what this earnings season holds. And it feels similar to the jobs report in that it's not necessarily about the numbers we get, because they're kind of stale in the context of, okay, the world has changed and theoretically will change when we implement tariffs tomorrow. How do companies even model what's going to happen? Are we expecting to see companies just pull guidance altogether?
That's a really good question, and it's a big possibility. And it really makes me think back to the early COVID months when a lot of companies, they were so uncertain about what the future was going to be holding. They weren't sure about supply chains and consumer confidence and all of these different things that they have to input in terms of looking ahead into the future. And so we have Dan Ives, for example, arguably the best known tech analyst, saying in a note earlier this week that with the current situation, he does not expect tech companies, most tech companies, to be giving any guidance on their first quarter calls. So we'll wait and see what happens. We're going to hear from companies pretty soon, but that's a stark reminder of the environment that everybody's dealing with.
Doesn't help to leave people in the dark. Lori Calvasina yesterday was furious that these companies aren't doing more to guide investors. And what we didn't get yesterday, guys, from Jamie Dimon was his weather forecast. We don't actually know how bad he sees things coming.
Yeah, although we have heard, even in the last quarter's calls, we heard some CEOs speaking out against tariffs. You're starting to see a little bit more of that in corporate America. The Restoration Hardware call was hilarious, right?
It's instant classic.
Yes. So do you expect some of these CEOs to really come out hard against tariffs?
Like you said, more are coming out. I think it's notable that somebody like Bill Ackman came out over the weekend saying something like, this could be like a nuclear winter when it comes to the outlook, when it comes to the economy.
That's a weather forecast.
That's a really dire weather forecast. But those are really stark words. And that's somebody who had backed the administration, backed the president all along on a number of different policies. And so just to hear more people coming out and talking about what they're feeling and what they're seeing, what they're expecting,
right.
It's possible we start to see more and more as this drags on.
Well, just in the last minute we have with you, take us into how investors are positioning amid all this uncertainty. When you take a look at ETF flows, for example, I know that there's been a lot of two-way traffic.
So much two-way traffic, yes. It's a little bit difficult to actually look at the overall picture at this point because there is quite substantial dip buying happening with certain products. So, for instance, a levered NASDAQ 100 ETF saw a huge inflow yesterday, which obviously it can look great in the short term when you get a bounce. But overall, I think there is still a bit of a sense of we have to wait and see what further information we get. Obviously, we're getting headlines about different phone calls that the administration is holding with different countries around the world, investors reacting to those types of things, but it's still a bit too early to form an overall picture.
Right, you mentioned that big flow. TQQQ, which is 3 times levered, the NASDAQ 100 took in $1.5 billion yesterday, currently up about 11%, Matt Miller.
All right, we're looking at stocks really jumping up here now, 3.5%. The gains on the S&P 500 as we get just about a half hour into the session. Coming up the next hour, Carin of Franklin Templeton joins us. Plus, we get to hear from Snap-on's Nick Pinchuk, as well as Leland Miller of the China Beige book. This is Open Interest. 30 minutes into the trading day, and we have a rally on our hands. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up in the green, stocks rebounding from a 3-day sell-off as countries rush to the tariff negotiating table.
But a fight to the end is what China is pledging to retaliate as President Trump threatens to slap Beijing with an additional 50% import tax.
And fresh off his trip to Asia, we'll hear from Snap-on CEO Nick Pinchuk as Trump's tariff strategy sparks uncertainty and criticism from manufacturers. All that and more coming up, but let's check on these markets. The S&P 500 fresh off its session highs, now up about 3.6% on hefty volume. You take a look at what is actually moving right now. You only have 17 stocks in the red right now. This is a big, broad bounce back from really the carnage that we've seen over the last 3 days or so, Matt Miller. We'll have to see if it can sustain itself.
Yeah, absolutely. And let's talk a little bit about that carnage and the results. Joining us now is Carin, Fiduciary Trust International Head of Portfolio Management and Equities. And Carin, I want to talk first about, I think we were conditioned in the past years to put a much heavier balance of stocks into our portfolios. And they're also a much heavier mix of big cap tech stocks. So what did that 10% loss on Thursday and Friday, or 10% plus loss, mean for most people's portfolios?
Well, certainly portfolios are down on a year-to-date basis and have retraced a lot of the gains actually from last year. In fact, the market, as you know, has retraced the gains from 2024. So portfolios are definitely suffering in this most recent decline. The swiftness of the sell-off is quite incredible. I think that with the sell-off in the last couple of days, I do think for long-term investors, we've gotten valuations to the point where they're attractive as they've been in a long time. And I think that the market actually here, we were talking about this yesterday at our meetings, that there's some great opportunities that are coming up based on the rapid sell-off that we're seeing in the markets here. So, we saw VIX levels go up to 60. Sentiment was really negative. So it's not surprising to see this kind of bounce in the market.
Yeah, it's interesting, of course, to see that action in the VIX. There was actually a really interesting note from Bespoke, who said that on the VIX, so it closed at just below 47. Intraday briefly traded above 60, to your point. It's only done that on 52 other trading days since 1990. So some really historic moves that we're seeing in volatility. But there's a lot of talk about indiscriminate selling. You say that there are opportunities to be found, but how do you separate out what is being disproportionately punished right now versus what actually should be re-rating?
Yes, I think that is actually the most difficult part, because there is still a great deal of uncertainty out there. I think what's interesting is that this market sell-off and the conditions here are pretty much self-inflicted, right? So we have seen the markets correct and sell off to the point that's very similar to what happened during COVID. But what happened during COVID was clearly an unknown. There was a health crisis. And whereas today, some of these policies and the tariffs that are imposed can be quickly reversed if someone chooses to do so, right? And I think that there are definitely negotiations going on, as you guys were talking about. Countries are coming to the table to try to make a deal. So it's very difficult to try to gauge how much is priced in. But I do think that we've seen some stocks that have sold off 50% from the highs. We've seen stocks sell off about 30%. I feel like for the ones where we have confidence and conviction in terms of the CapEx spending, in terms of the growth for the future, those stocks are probably where investors want to gravitate towards at this time.
I also want to know what you're going to do at this point with bonds, because the 10-year, we've been talking about it. I was thinking Jim Bianco is calling this is a tell your grandkids kind of moment in the bond market when you see a 10-year spike by almost 19 basis points yesterday and another 7 today. We're at 425 on the 10-year. We were sitting here with John Hancock's Matt Miskin, who said that you could see in the event of a recession, yields drop significantly. Was the two-handle, Katie, on the 10-year?
You did say a two-handle.
I almost have to say it twice. It's so low if you see a recession. So what do you do? I mean, do you pile into bonds, or is it too risky?
Yeah, so we think it's really important to have a diversified portfolio at this point. So bonds offer some protection in case, right, it's really, as we mentioned, it's really unpredictable. So bonds can offer a buffer in portfolios. We, in our strategy, we've been overweight fixed income for some time. We felt that valuations on equities were very expensive at the beginning of the year. Valuations have corrected on equities. And we also think that at this juncture, there is an argument to actually have a fully diversified portfolio, including bonds, including equities. And within equities, you also want to have a diversified portfolio. We've been coming into this year, we favor, for example, defensive sectors. But now, they've outperformed so much. And you've seen cyclical stocks actually get really beaten up here. And so from that standpoint, I really think a barbell strategy in terms of asset allocation, in terms of a balanced portfolio, and even within equities, barbell, high growth, and barbell value dividend stocks. I will also be neutral cyclicals versus non-cyclicals.
What about international? I mean, do you want to invest in a place where fiscal policy is better telegraphed and the rule of law is more consistent?
So I think that that's a good question. I mean, we've seen international markets rally year to date and have outperformed the U.S. markets. I think we're probably coming to the sort of end of that in the sense that, they've rallied on a valuation recovery. But, the international markets aren't necessarily better off from an economic growth standpoint. And so, at this point, I wouldn't necessarily be adding more money to the international markets. We keep our exposure there for diversification. But there does appear actually to be, I think, potentially a little bit more of a shift back to U.S. equities.
All right, Carin, got to leave it there. Great to see you, especially in person. That is Carin Pay of Fiduciary Trust. Meanwhile, the S&P 500 sitting near session highs, up about 3.8%. Let's get a look at what's moving underneath the surface with Bloomberg's Denitsa Seikova and those health insurers certainly helping this index.
Yes, Katie, we're seeing some of the big winners there. We're seeing gains of, they were as much as 11% in the earlier trading. But if we look at United Healthcare, if we look at CVS, we're seeing very strong 7-8% jump today. Of course, this is coming on the back of news that the U.S. government will pay private Medicare Advantage plans more next year than expected. And actually what we're hearing, this is way above expectations. We're talking about a 5% average rate, which is more than double what the government suggested in January. If we have to put a stat on this, this will be $25 billion more being paid next year from the government to Medicare Advantage. Clearly, this is lifting the sector. Some of those names are one of the few stocks that are up on the year. Obviously, today is especially good day. And those companies have been facing a lot of scrutiny in Washington lately. So this is kind of the best days for all of those so far this year.
Let's take a look at Nike also, because, of course, since Liberation Day tariffs were announced, it's been hard hit. It bounced back. It's bouncing back a little more today.
Yeah, for sure. Nike is kind of a good proxy of that buy the dip sentiment. It was actually up about 5% earlier today. We see still a gain of 4%. What we've seen there is a lot of the relief came after the negotiations with Vietnam that the president was saying that they're doing well. Obviously, there is some expectation about Cambodia, Indonesia as well. Today, we have more positive language coming from the White House about the melting cube. And obviously that is helping, and Nike is a good proxy of that trade. That said, when it comes to earnings, we've seen some worrisome signs there, but still we clearly see that investors are happy to ignore that if there are positive developments on the macro front.
What's the story with CME? They got an upgrade?
Yeah, I love that. They got an upgrade from Morgan Stanley, CME, CBOE. So we're seeing all those big exchanges that will benefit from market volatility. And clearly today is a buy the dip day, but we saw the VIX. We saw what's been happening in the last few weeks. So while they're upgrading CBOE, while they're upgrading CME, they're actually putting equal weight on Robinhood. So there is an interesting arbitrage where Morgan Stanley is positive and is finding defensive positions positioning in those big names that work with institutions and bigger investors, but they're growing more pessimistic on Robinhood and all those brokerages that obviously work with retail. Even though we've seen some dip buying, clearly companies are worried that the retail traders will get a lot of pressure in the volatility, which practically we haven't seen since 2020.
Yeah, and Robinhood shares defiant today, up about 5.7%, but so is everything else. Bloomberg's Anita Seikova, great roundup. Now coming up, billionaire Ken Griffin blasts President Trump's tariff policy. We'll bring you his comments next in our Wall Street Beat. This is Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. President Trump is rejecting a European Union proposal to drop tariffs on all bilateral trade with the U.S. They wanted to completely get rid of them, and we decided no. That means his 20% tariff on EU imports will come into force tomorrow. The EU will begin consulting with member states and industry early next week on how it plans to retaliate. Global investors are finding credible alternatives to U.S. Treasury bonds as yields on the 10-year Treasury tumbled to below 4% over the past few sessions. Comparable rates in both Europe and Japan remain higher this year. While both are still well below Treasury yields, they're at levels that make them look more attractive. That might entice investors to shift allocations to markets where the policy outlook appears more stable. And Bluecrest Capital Management, a hedge fund founded by Michael Platt, is up 20% this year as it navigates the market turmoil sparked by President Trump's tariff moves. Bluecrest solely manages the wealth of Platt and his partners. It's delivered some of the best trading profits in the world. Sonali?
And it's time now for the Wall Street Beat. We are looking at Citadel's Ken Griffin. He is calling the president's tariffs a huge policy mistake. In a quote, he spoke at an event in Miami yesterday and warned about the impact to the middle class. We're going to now bring in Bloomberg's chief hedge fund correspondent, Nishant Kumar, to talk more about this. You know, I actually had the first real interview with Ken Griffin in the wake of the election. He said that at that time that tariffs would lead to crony capitalism. Now he's calling it a huge policy mistake that will take a tax on the middle class. How widely spread are these views? What's interesting to me about Ken Griffin speaking in Florida is, of course, that is close to the other center of power in Florida, which is, of course, Mar-a-Lago. Do the people around him share this view, or is it controversial?
Well, it's increasingly becoming the consensus view, it seems, especially among the billionaire fans of Donald Trump. I mean, they are probably having their oops moment right now. Few expected him to go through this sort of a policy and engage in this sort of a Twitter or X war, sending messages every morning and causing volatility in the market. So for sure, like Bill Ackman is one of them who came out and said that, he did a mistake and he doesn't, the tariff will cause economic nuclear winter, in his words.
So, Nishant, when people close to the administration or close to the GOP, and I understand that Griffin is not a donor to Trump, but obviously, he's given $100 million to other Republican candidates and causes. Can you say that it's that their criticisms are based on losses? For example, Ackman had a big investment in Nike, right? Or Musk, obviously has big investments in China. And so Trump allies are saying, hey, they're just being critical because they're losing their own money. Is Ken Griffin losing money based on the tariff policy that went into effect on Saturday and what's going to go into effect tonight?
Well, Ken Griffin hasn't lost money. His investment firm was flat almost last week. It lost just 35 basis points. So in his case, especially, it doesn't seem to be driven by the returns itself, but generally its view on the economy and how the tariff policy is really starting to affect the economy, the chances of a recession in U.S., and of course, the stock market and asset prices melting.
And, I would say we don't know the numbers actually for the first quarter for Citadel Securities, but given the volatility, what the bank's trading desks do, I'm sure will be a good barometer of how well they're doing. Nishant, I want to kind of knock down the notion that all hedge funds are failing or all family offices are failing in this environment. You are out with the headline of Michael Platt's Bluecrest just soaring. Bridgewater, at least through March, was really up. Double digits, close to double digits, if not more. Schoenfeld is up. Who's benefiting in this environment?
I mean, really, Michael Platt making money during episodes of volatility is not news anymore. Like, he does it all the time. He has this amazing money printing machine. I mean, look at his returns. It's annualizing at 30-40% since he returned capital to investors. The key behind his stellar performance is, of course, mountains of leverage. That's what makes a trade click, and that's why he makes so much money. But generally, if you look at multi-strat world, I mean, they have fared, considered like really well. I know zero is not a number that one celebrates when it comes to returns, but essentially, if you were flat last week, that was a remarkable achievement. And we see that across multi-strategy hedge funds. Schoenfeld even made some money. Citadel kind of flattish. Millennium minus 70 basis points. Balyasny flat. So these are some really solid numbers at the time of this market chaos.
All right, Nishant, thanks so much for joining us. Bloomberg's Nishant Kumar reporting on hedge funds out of London. Still ahead, Elon Musk calls Trump trade advisor Peter Navarro a moron. Says he's truly a moron as their White House feud turns ugly. We'll have details next. This is Bloomberg Open Interest. A new White House feud is spilling over into the Twitter sphere. Peter Navarro, President Trump's top trade advisor, who also apparently goes by the pseudonym Ron Vera, dismissed Elon Musk's push for zero tariffs between the U.S. and Europe, calling the Tesla CEO not even a car manufacturer, but a car assembler reliant on parts from other countries. Musk, meanwhile, just posted on X, quote, Navarro is truly a moron. What he says here is demonstrably false. By any definition whatsoever, Tesla is the most vertically integrated auto manufacturer in the United States of America with the highest percentage of American content. Navarro should ask the fake expert he invented, the aforementioned Ron Vera. Let's bring in Bloomberg technology co-host Ed Ludlow with details. So aside from, the fake economists that Navarro cites in his research, what do we know about this feud?
Well, I think there is certainly a rift between Elon Musk and others around Donald Trump on the issue of tariffs, right? There were reports over the weekend that Musk had made a direct appeal to Trump in the hours that preceded the news of Monday and the markets of Monday to rethink the tariff stance. What's interesting, though, is Tesla is the most insulated of the US automakers and the foreign OEMs that manufacture in the United States, right? There is data, it is in Tesla's 10Ks and the annual impact report that it publishes about the volume and locality of components that are assembled. So take Austin, for example, Austin, Texas. Tesla's VP of Finance pointed out that the powertrain or drivetrain components, not just the assembly of the car itself, but the motor and the battery pack are all done there locally on site. And, Musk himself referenced this Kelley Blue Book data that Tesla makes the most American-made cars. But that's data that's there to see. Clearly, there is some pressure, though, coming from somewhere.
Yeah, absolutely. I do want to check at Tesla shares up about 6.7%, close to a session high. I don't know if that's related to this feud that we're seeing play out on social media. But Ed, you make a good point. I mean, that there's folks within Trump's inner circle who are feuding right now. Elon Musk, obviously, is part of that feud. And this comes as potentially we're counting down to when his time as a special advisor to this administration comes to an end.
Yeah, I mean, the Doge position is a remit. You know, it's in the documents communicated by the White House that it has a term limit up until, I think, July 1st, right? And the White House has very recently denied a report that Musk would leave that role early. They said it was, you know, fake news. But at the same time, like up 6% in a session, what does that mean in aggregate over a week where Tesla's been absolutely hammered? There's big concerns from the market that just by association, forget the tariff risk. Of course, there is some modeled into Tesla's share price because raw materials, and there is an element of cars exported from China to the European market. It's a global story. But the association risk is the bigger issue with this stock, right? That consumers have a strong opinion of Elon Musk by his association with what the administration's doing, and that might have more of an impact.
We have less than a minute left. Where do you see Elon Musk's objectives clashing the most with the administration's?
Well, the one that I'm waiting on, you know, people have short memories with respect in the markets, is that Musk said very publicly on a Tesla earnings call that he was going to use his position to federally regulate self-driving cars. There's a June deadline that Tesla has self-imposed to launch its robotaxi service in Texas, a soft launch. You know, that would be a major story. That suddenly federal regulations appeared for this nascent technology influenced by somebody who has a clear remit in Doge, right? Irrespective of his relationships or lack of with the wider Trump cabinet.
All right, Ed, great reporting as always. Great to have you back, too. That is Ed Ludlow, the co-host of Bloomberg Technology. Meanwhile, a quick check on markets right now. The S&P 500 up by 3.7%. That is the biggest intraday rally since November 2022. Remember, 2022 was a painful year for the S&P 500, so do with that what you will. But coming up, China pledges retaliation against Donald Trump's latest tariff threats. We'll speak with the CEO of Snap-on next. This is Bloomberg. Well, China says it's not backing down from a tariff war with the United States. The Chinese Ministry of Commerce said in a statement, if the U.S. insists on its own way, China will fight to the end. Tools giant Snap-on will speak to his CEO now, Nick Pinchuk. He just returned from a trip to Asia. He joins us now to get a boots-on-the-ground read on manufacturing overseas. And Nick, my understanding is that you have 5 factories in China. So what does this mean for your business?
Well, Katie, I think, you know, we're a little different in that we tend to make in the markets where we sell. So our 5 factories in China are there principally to try to sell in the Asian market. You know, we make in the 80% of what we sell off the trucks is in the United States. Is made right here. But in terms of what it means for the factories in China, of course, they export some to the United States. And so they may lose that volume depending on how high the tariffs are. 104%, which would be the 10 plus 10 plus 25 and the 34 and 50 more would be 100. That would be difficult to overcome. And so we'd probably adjust to that. But I think they're not shaking in their boots. They're worried about it, and they'd have to step up their efforts to focus on the Asian markets. That would be what happens. I do think, though, in Asia, that many of the companies that are particularly in China, are operating at small margins and can't do very much about absorbing the tariffs. So they're kind of worried about it. They'll probably try to adjust for a while, but they won't be able to do anything. And I don't think the Chinese government is in a position, you know, I think they're pretty serious about trying to resist the tariffs because I think Xi Jinping has sitting on an economic difficulty right now. He's not going to want to seem to kowtow to America. In fact, I think he said something like that last night. And so I believe we're in for a little bit of, turbulence with the China market as well.
Nick, I got to ask. I was in Austin last weekend riding a Harley-Davidson Fat Bob, and I needed to change one of the foot pegs. So I pulled over quickly at Home Depot, and I bought a Husky, made in China double ratcheting wrench. It was $32, I think. I look at the same wrench on your website, and it's like $110. So already you're priced much higher than that Chinese-made stuff at Home Depot. Are you going to have to raise prices even further when these tariffs go into effect?
Actually, right now, I don't know how we can afford to sell it for that price. It's so good a wrench. It's like a bargain. But look, I don't think that in the United States, actually, wrenches are pretty much made here. We're using American steel. Now, to the extent American steel goes up, maybe we'll have to price for that. The thing about this is what's kind of interesting when you step back and look at the tariffs. Right now, we're in the fog of tariffs. You know, I think this is Clausewitz or Robert McNamara talked about this kind of thing. There are so many variables that people have been trying to figure out how to sort their way through it. But the way forward is going to be that they are going to try, you know, companies are going to try to resource or reshore things. We're already reshored, so we don't have too much of a problem. We're not immune to the tariff problems, but we're resistant to it. But here's the difficulty. It's going to take years. It's not so easy for that to happen. To make something like handles, one thing to assemble in the United States, it's another thing to make components out of steel or other difficulties in complex shapes and manufacture them. We had a competitor who tried to do this. People talk about, well, maybe technology will ease the way. We'll all have robots. We have robots all over our plants, but they have been robots and technologies that's been overlaid on know-how that's already there. We've had competitors who have tried to build tools in the United States, robotizing everything and spit up blood all over it, had to write it all off. So it's not so difficult. So
Nick,
you're going to see some time for this to come on.
Well, one other aspect of this that I find to be confusing at this juncture in the trade talks is you have President Trump coming out talking about his talks with South Korea this morning. You have Kevin Hassett of the National Economic Council talking about prioritizing trading partners, allies like South Korea and Japan. You have Apple talking about India as another base for making iPhones, for example. What if this isn't a matter of onshoring all manufacturing? To what extent is this just about moving manufacturing and imports away from China?
Okay, if you want to move away from China, I say good luck. Vietnam, I was in Vietnam in the war, and I've been there maybe dozens of times since. Tough. India, yike. So it's not so easy to do that. You might as well move it to the United States. See, the thing about the United States, the advantage the Chinese have is not only lower labor, they have lower regulations and they have an availability of the workforce. We need that in the U.S. One of the things I will say, and the National Association of Manufacturers will say this, we don't need the tariffs to impel onshoring. After the pandemic, when the supply chain was interrupted, there were all kinds of industrials trying to go here and say, we cannot depend on these long supply chains. The manufacturing goods are too important. We can't leave our prosperity in the hands of other countries that might interrupt them by happenstance or by intent. And so we ought to onshore. But it wasn't easy to do because there wasn't enough skilled labor, and the regulation is tremendous here. The National Association of Manufacturers says that the average manufacturer pays $25,000 per year per employee on regulation costs, and small manufacturers, which is 93% of those manufacturers, pay much more per employee. Right. So those things need to be fixed more quickly. And then if you fix those, I believe people will come here because they've now been convinced we cannot depend on other countries for the manufacturing, either for our companies or our countries. The idea, one of the great things that comes out of this tariff thing is you say, well, wait a minute, it's going to take us 5 years or 3 years to put manufacturing onshore. Well, what does that mean about depending on other countries like India or Vietnam or China or other places for that? If there's a natural disaster or a conflict like, Sam Huntington, the Clash of Civilizations, we won't be able to replace that very quickly, and we'll be at a great disadvantage. And I think people know this, and therefore they're interested in onshoring. It's just we need more workers. We need to upskill the American workforce. We need to convince people that manufacturing is an American calling, not just being a place where it's dark, dumb, and dirty. It's a place where you can keep your families warm and safe and dry and have the dignity of work around creation rather than transaction or service. And you'll have a great pay and great life associated with it. And I think that's why the tariffs are kind of interesting, but they're not really needed in that situation. Right. You may want to tariff punitively or countermeasures like people like China, because Alexander Hamilton said in 1791 that that's an appropriate thing. If someone's trying to asymmetrically empower their country champions to penetrate your own markets, you have to take actions. Mm-hmm. And so China may be one of those places. But the broad tariffs are not necessary.
Right.
It's a good point to end it on, that, tariffs aren't going to fix the problems that come with, the labor market. When it comes to some of this workforce, it needs a messaging refresh. Nick, we got to leave it there, but have to have you back on soon. That is Nick Pinchuk of Snap-on. Meanwhile, a quick check on these equity markets. The S&P 500 still hanging out near session highs, up 3.7%. It's big tech that's leading that big rebound, rather, and you can see that in the NASDAQ 100, up more than 4%. But Sonali, that bond sell-off continues all the while.
Yeah, it is a pretty incredible thing to watch. A lot of theories around exactly where that's coming from. We will get you everything as we know it. But right now, we're going to get you what we know about stocks moving under the hood this hour. Bloomberg's Isabel Lee. We were watching Walgreens get a bit of a lift. Are we still seeing it?
We're still seeing it. It's up around 1.5%. And Walgreens reported earnings that exceeded expectations. And this really marks a strong performance for a company that might be reporting one of its last earnings as a public company. Recall that Walgreens was acquired by Sycamore Partners for around $10 billion, and it will push through by the end of 2025. So the company reported adjusted EPS that reached 63 cents. That's higher than analyst estimates. Revenue was also $38.6 billion, which is also higher than estimates. So this is really welcome news for investors, because Walgreens, after all, is the second largest U.S. pharmacy chains, and its value has really just decreased the past decade.
What's the story with Blackstone? We were talking yesterday about how deals are dead, but not all deals, right?
Not all deals. We see Blackstone edging higher by around 4%. Citizens upgraded the private equity firm to market outperform from market perform, along with its peers Ares and Evercore. So Citizens analyst Devin Ryan says that these three stocks look more compelling relative to their long-term earnings power, and that's following the recent massive sell-off. He adds that uncertainty is, quote, poison for financial services businesses. And of course, Ares is up around 4%, Evercore up around 6%.
I thought you were going to say Blackstone is up because it's selling its a healthcare business to Bain Capital.
It could be because of that too.
According to the FT.
We do have that crossing the wires too, but we also have this one. Multiple things can move a stock.
We'll keep an eye on this. I do want to mention Janus Henderson really quickly. Shares up about 7%. It's kind of a deal. They're partnering with Guardian. They're going to become Guardian's investment-grade public fixed income asset manager for a $45 billion portfolio. So you can see Janus popping quite a bit on the heels of that news. But let's talk about jeans, because Levi's has had a really interesting move today. It was up 16% after earnings, but clearly that's come in a bit, Isabel.
But it's still up by 1%. This was really massive and notable because the firm maintained its full-year outlook, and they excluded the impact from the sweeping U.S. tariffs. And this is notable because usually companies have said that tariffs will affect the cost of clothing, but we have Levi's saying that it assumes no significant worsening.
But they're just ignoring it?
For now, and they also said that tariffs
we're putting our heads in the sand for now.
There is a reason. They said tariffs will have, quote, a minimal impact because most of their spring and summer collection are already in the U.S. So there is that. So when you shop, know that they've been sitting in the bodega or whatever room they store that in. But we have the CFO, though, saying that it's difficult to forecast this, and which is why you see, I think, JP Morgan raised Levi's to overweight, but we have Stifel and Telsley downgrading the stock.
Love
mixed
good
reactions,
guys. Anyways, Isabel, thank you so very much. That is Isabel Lee of Bloomberg News. Now, coming up, the U.S. and China are not flinching as tariff tensions escalate. We're going to bring you analysis from Leland Miller of the China Beige Book International next. This is Bloomberg Open Interest. Now, President Trump said prospects for a trade deal with South Korea were looking good after a phone conversation today with acting South Korean President Han Duck-soo. But the president was less optimistic about a negotiation with China, though he did say the nation badly wanted to make a deal. Of course, we're going to want to hear from China as well. And for more, let's bring in Bloomberg's Brendan Murray, who leads our global trade coverage. When you think about the net effects of what we're seeing right now, you're seeing the administration rushing to put points on the board with every single partner that they consider an ally. But does it amount to enough to de-escalate this trade war when really the giant in the room is China?
Yeah, so far we've heard them say that they're going to enter talks with Japan, with South Korea, as you mentioned, also with India. But as you suggested, the situation with China, the relationship sounds like it's worsening. The two sides are growing farther apart in their desire to get together and start talks. The president did say that he thinks it will happen in a social media post today, but that's not the way the Chinese operate. They don't operate under pressure. They don't like to be, as they called, blackmailed. So the situation is going to have to cool down quite a bit before China is willing to come to the negotiating table. In the meantime, we're looking at, it's a matter of hours now before Trump's reciprocal tariffs take effect. That's going to add 34% of a tariff on top of the 20% that's already there. Plus, the president has threatened an extra 50%. So theoretically, by the end of today, the tariffs on Chinese imports into the U.S. could be above 100%.
Brendan, thanks very much. Bloomberg's Brendan Murray is in charge of our tariff and trade war coverage out of London. Let's stay on this game of chicken between the world's two richest economies. We're joined now by Leland Miller, CEO of China Beige Book International. Leland, how do you see this playing out? Does China have the cards, as the Trump administration would probably put it, to continue?
Well, it depends when you're talking about cards. If you're talking about a deal, you need two sides to tango. So, if Trump wants a deal with China ultimately, then they're going to have to come to the table and they're going to have to get something in return for coming to the table. If you're talking about whether the economy can withstand an extended tariff barrage, that's a different story. So, I think that so much is going on right now. It's not just about U.S.-China, that I think that both sides are looking at the other and saying, is our leverage weakening or is it improving by what's going on right now? And I think that's going to affect, the trajectory of whether there's a negotiation in the short term.
Leland, I want to get your thoughts on what is actually playing out right now, because there is the narrative that still exists out there that Trump is using these tariffs as a negotiation tactic. You had the Secretary of the Treasury suggest as much, perhaps earlier today on CNBC, calling tariffs a melting ice cube. But then you have the other camp saying that no, Trump is very serious about these tariffs. These aren't bargaining chips. I wonder where you fall.
Well, it's not easy to pick out what the theme that the Trump administration wants when they send out two different camps saying totally different things. But I think when you look at the tariffs, they were clearly created with an outcome in mind. The levels are relatively arbitrary. They're much higher than most people expected because there's a shock and awe effect. That also lets you cut tariffs in the short and medium term considerably, and yet still keep them high, which will make everybody in the White House relatively happy. So, look, there's nothing about the tariff regime that's been laid out that can't change, that can't be brought down, that can't be subject to a bunch of negotiations. You could see some tariffs go up if there's retaliation. You could see a lot of other ones go down. I think that we're not going to see the tariff levels stay at this into the next couple of months, maybe shorter than that. But I think there's going to be a lot of movement on the tariff levels going forward.
Now, I want to bring up here what's happening on a country-by-country level here, because I'm wondering if this is just a brute force question or a game of game theory. Because if you look at, I added up Japan, South Korea, India, and Vietnam, the combined total imports from those countries are 461 billion, which is more than China. Now, the composition of those imports are different. Of course, there's a huge reliance on China for certain industries, like you see with Apple. Is there something to be said here about the way the Trump administration is approaching broader Asia in relation to China?
I think there's two issues with Asia when you look at the broader Asia picture. The first is that a lot of them run trade surpluses in the United States, and that bothers this administration. The second is a lot of them are transshipment points for Chinese goods or destinations for Chinese factories that have been trying to get around tariffs. So when you're looking at the issue, they're going to have to come to terms with the fact that not only are tariffs high there, and trade surpluses quite high in most of the countries, but also that China uses them as a way of getting around tariffs that we put on China. So you're going to have to settle the Asia question, but you're going to have to do it with China. It's part of it. Otherwise, you're going to have a bigger problem. One of the reasons we saw Vietnam's trade surplus skyrocket over the last several years because we put tariffs on China. And so Chinese capital and Chinese factories and Chinese shipments went to Vietnam to circle around those tariffs. So you're going to have a comprehensive tariff strategy for Asia that includes China. You can't just target these things one by one bilateral and expect the numbers to change.
What are the levers that China has to pull to make this painful for President Trump? Not that I'm hoping they do that, but I noticed they're extending loans to stabilize their market. They're imploring that their domestic producers don't move supply chains. What are the things they can do? Because I don't feel like putting tariffs on U.S. imports is going to really be a problem for us.
No, that's right. Look, from a domestic standpoint, it's a non-commercial financial system, so they could buttress the economy any way they want in order to withstand the barrage. They could, of course, increase fiscal spending. I know a lot of people have been predicting that for a long time. We're actually seeing evidence of that starting in China based on China Beige book data. But I think it's about what China's going to do to bolster its economy domestically, but also what it's going to threaten or signal that it can do back to the United States. And the question there is how nuclear it wants to get. If you're simply talking about reciprocity on tariffs, you're not going to do much because the United States imports way more than China imports of U.S. goods. So you're going to have to start talking about critical minerals even more than you are now. You're going to have to start talking about supply chains and with withholding certain goods. You're going to have to talk about punishing U.S. companies on the mainland, which I know a lot of people don't want to see. So there are ways that they can escalate quite dramatically. And then, of course, there's currency policy, which is sort of a break the glass threat. Only in an emergency do they want to pull that lever. But there are some things they can do. But again, these would be significant escalations. I think Beijing would prefer to stay away from those as long as it thinks it can still get back to the table with the Trump administration.
Well, just on the point you made about the currency, the offshore yuan fell to its weakest level on record just a few minutes ago. So you're clearly seeing the FX markets really absorb and react to a lot of these different dynamics. But Leland, I do want to look out into the future and talk about the long-term macroeconomic impact here, because you write in the notes you sent over to our producers that even if we do see these tariffs come off in 12 to 25 months, we're not going back to the environment that we had in 2024.
Well, that's right. If they stay on 12 plus months, then you're not going to go back to the environment you saw before, which is why I don't think they're going to stay on for 12 months. I think that there's going to be right now, the tariffs are very high. They can come down and still stay very high. I think the Trump administration has to come to sort of a collective decision, with Trump obviously making the ultimate decision on where they want rates to settle, how they want to do the negotiating process. There's a lot of countries that want to come to the table, and how do they get things so that they can establish some level of certainty. Regardless of whether tariffs are high or low, you need that certainty so that supply chains can adjust, so that trade flows can adjust. Until you get the certainty, you're not going to get the results you want, even if this is the best, most well-crafted policy in the history of tariff policy.
All right, Leland, great to talk to you. That is Leland Miller. He is the CEO of China Beige Book International. Meanwhile, a quick check on these markets right now. The S&P 500, it's not quite at session highs, but it's up by more than 3%. So a really robust rebound from what we've seen over the past few days. We'll discuss next. This is Open Interest. Welcome back to Open Interest. A check on these markets right now. The S&P 500 higher by 3% right now. It's big tech that's leading the rebound, but let's take a look at the sector level because everything is green today. Of course, you do have tech out in charge, but if you pull up the sectors, you have all 11 in the green. You can see that financials also catching a bid ahead of Friday, Sonali, when the big banks report. But if you go down the list, you can see that this is a really robust rebound. We're seeing a lot of breadth right now, but there are those skeptics out there that warn this could be a dead cat bounce.
Dead cat bounce. We'll see where things go. I would point out that the VIX is still very elevated. It's still just under 40 at around 38, which means that even though we're seeing this bounce, that's a little fear still under the surface here. The banks like that volatility for now. At what point does it get too stifling?
It's amazing, though, how much this dead cat is bouncing, right? Because it's the fastest gain we've seen in one session since 2022, and 2023 and 2024 were really good years.
Yeah, but 2022 down 19% on the S&P 500. We'll see if we get a repeat.
Coming up tomorrow, Gabriela Santos joins us from JP Morgan, as well as Cole Smead from Smead Capital Management. This is Bloomberg.